At Matarin, we have a positive outlook for the stock market right now, but as you know, we always want to also pay attention to what kinds of stocks are leading the market up to assess the health of the rally. So we track something that are called factors, which are quantitative indicators that help us to classify or group different kinds of stocks. And what we've seen so far this year is that it's the high beta factors that are the top performing in the market.
Not necessarily new by any stretch of the imagination, right? I mean, those are the stocks that sort of have led for the last, decent period.
12 years.
Well, it's if you compare what we saw during the fourth quarter with what we've seen during the first quarter, that's quite a change. And in fact, if you look month to date, that you'll see that actually the low volatility is starting to come back. Over time, you'll find that the high beta factor actually tends to be the lowest performing factor that you can find. We like to track something called the S&P factor dashboard that looks at the performance of all of the S&P factor indices over time, with 15 years being the longest term period that they look. And high beta was literally the top performing index during Q1 19 and also the bottom performing index over a 15-year period.
The rally, though, has seemingly gotten more broad of late, right? The breadth of the market's better lately than you could say it was, maybe, a couple of months ago.
Even during April alone, we're starting to see a turnaround in breadth.
Yeah. Joe?
So how do you incorporate growth in that environment? Because the problem that you run into, and I agree with it, and I think active managers have failed in this low volatility environment because they assume too much beta. They don't need to. They probably just would be better off with low beta portfolios. But the only growth you're seeing really is in the high beta names. So how do you get the confidence to go invest in names that are not exhibiting the growth, right? In a world where you've got low interest rates, you've got contraction internationally and in the emerging markets, and even to a certain extent in the U.S., how could you kind of ignore that growth opportunity?
Well, think about the difference between growth and volatility. We found success at Matarin by focusing on companies that are growing, but in a stable way, not the kind of high volatile growth that tends to become expensive and overpriced. The problem with volatile growth is often just behavioral, that it becomes so hot, so sexy that investors start to chase it and tend to overprice it. If you can find companies that are growing in a more stable way through time, then they're less likely to fall into that trap of being priced to perfection and overly expensive, and you can tend to do better over time. The story is not to avoid growing companies. Growth is what we need as investors, but we just need to think about how that growth is traded and priced by others.
But Margaret, I was going to go to you next. I mean, it sounds like you have a similar idea on where you think the rally is going to go, or the sectors that are going to be rotated into.
Well, but I would just echo the fact that I think everything that you've said this morning is definitely just part and parcel of why active management is so important, because it's all about risk control. So in that environment where it's high beta, where we as active managers that focus on quality companies, we might be as much exposed, but we try to find those companies that can grow with the market or outgrow the market in a sustainable way, in a high quality way. So I think there's segments of the market that can check all those boxes, and it's just about being disciplined on the companies you own.
Yeah. Nili's also here today because we do have, as we've told you before, CNBC has a financial wellness and education initiative. It's called Invest in You, Ready, Set, Grow, and as part of our partnership with Acorns, the micro investing app. One investing strategy gaining attention is sustainable investing, and you published a piece on CNBC.com that I thought was very interesting today that I wanted to talk to you about, sort of in conjunction with a new index that you guys have. Why don't you tell me about the index that you're launching and how it plays into this longer, more sustainable sort of investing strategy?
Well, first of all, happy Earth Day to everyone. Yes. It's Financial Literacy Month and it's Earth Day, so it's a great time to be here to talk to you about both of these themes.
Absolutely.
We were really excited to have the chance to come together with S&P to launch a new global long-term investing index, which is focused on sharing the story that when you think about factor investing in the market, that there are some factors that are short-term, like high beta, and some factors that are longer term. They take a longer time to pan out, which actually includes sustainable investing themes. And what we found in all of our research is that the longer term themes actually do tend to offer a higher risk adjusted return to investors if they can be patient and wait for the return of their capital. As a matter of fact, we believe that there's a patience premium available.
Which I love that. I love the way you call it that.
Thank you. Thank you. That there's a patience premium available in the stock markets for investors who are able to train their focus on these longer-term themes.
So, obviously, if you're a trader, a shorter-term even investor, you're not necessarily focused on so-called ESG, right? How could you be? Maybe you're not interested or care at any way about what a company is doing for environmental or sustainable investing. Longer term, though, it's almost part and parcel, right? If you are a long-term investor, then you can naturally be focused on these areas.
Sometimes people say to us, what's the difference between financial sustainability, business sustainability, and long-term environmental or social sustainability? And we say exactly what you're saying, Scott. We see them as being part and parcel of the same thing. Let's say you want to earn the patience premium, and now you know you're going to be invested in a stock for periods of years. At some point, you've got to start asking, how is this company preparing for the environmental realities of the future? Are they retraining their workforce for the future of the labor market? Are they investing in the communities where they want to be selling goods? And this is really good news because coming back to Financial Literacy Month, there are many individual investors as well as institutional investors today who are trying to ask themselves, how can I take these issues into account in my investment decisions in a way that will do no harm or maybe even help returns?
I love the concept. I love the concept. Is there a sector specifically that you could identify that is going to get a higher weighting because they are more responsible? And we look at the S&P and we look at weighting in a much less traditional way where technology gets the highest weighting. But who's the most responsible and gets the highest weighting now?
Well, when you look at a lot of so-called ESG indexes, environmental, social, and governance indexes, they tend to have certain concentrations in sectors or industries like tech or growth and away from things like industrials or materials. Well, what we've done in the global long-term index is we did exclude fossil fuels and tobacco. But beyond that, we actually wanted to have similar weights in the global sectors to what you can find in a traditional broad market benchmark. Because one of the things that we've talked about here on Halftime Report before is that sometimes when investors are investing in factor indexes, they end up with a pattern of returns that has more to do with sector concentrations or region concentrations than the basic factor themes that they're trying to invest in. So here's a way to invest in sustainable long-term investing without taking on undue sector or regional risk that isn't part of the broad thematic approach.
So, Nili,
So I've done quite a bit of work on this area, particularly on governance, and there's a real controversy as to whether sustainable investing works or it doesn't work.
Yes.
CalPERS, they kicked out one of the heads of CalPERS because their returns and their sustainable portfolio were underperforming. So they had a big uproar, they got him out. I happen to believe in it. What are you doing in governance? Because I'm very, very focused on governance. Recently met with the SEC, have been talking to a lot of large institutions. And to me, there's not enough attention spent on governance as there is on sustainability or environmental. So how does that factor into what you do? I mean, governance, Tesla, poor governance.
That's exactly what I was thinking of as you were saying
Bed Bath
that.
Beyond, no governance. So how do you factor in that?
or I would
into what
add
you
to
do?
the dual class structures. How is that embedded in your results, in your
It's
research?
interesting that you say that. You know, I kind of disagree. It seems to me like governance issues have been easier to get across the bow from the perspective of fiduciary responsibility, because evaluating the board, how a company is managed and run, is more of a core part of traditional investing. But when you make the point about some of the challenges, depending on the study or the plan that you look at, to returns for sustainable investing, one of the things that we're focused on is, again, what's the theory of investment returns? So let's say that we agree, which we may not, that you think that there are potential returns to be earned from investing in companies that are well governed or doing well in social and environmental issues. If you buy the company that everybody already knows and loves is a great ESG company, then shouldn't that information already be priced into the stock?
These are great points, though. I like Tesla as a specific example, okay? You could say it fits into an ESG strategy because of, obviously, the electric vehicle. Right. And then you could say, well, because of the governance questions that have existed over this stock for the last however many months we've been talking about this sort of thing, and the tweets, et cetera, they could cancel each other out. I love the dual class issue that Margaret raises as well. Those are significant issues for investors when deciding whether they fit into this type of strategy.
Lyft is another one.
Stick with
Lyft, exactly.
Lyft is another one. You dual class, but
yeah.
I mean, they're saying, you don't have to own cars allegedly because, you can ride share.
Stick with the example of Tesla. It's a company that a lot of investors who care about sustainability already love and have bought because of the environmental profile.
Sure.
But if you look at the trends in its environmental, social, and governance standpoint, you'll see negative trends on the governance side. So that's why for the Global Long-Term Index, we're actually not focused on buying the companies that are the darlings or ignoring the companies that are underperforming, but actually trying to identify companies that have positive ESG trends, so that if you believe that you can get in early and be a long-term investor and ride the wave of good news on the way up, that's how you can unlock some potential future
Just one more
stock price
question for you. So,
quick.
A lot of work on this again, and the data sources on ESG come out once a year. So is it a static portfolio, just turn over once a year, depending upon the changes they make?
It is a portfolio with an annual rebalance.
Great seeing you. Thanks for being here.